So there we are. So today's topic is presentation of published financial statements. A financial statement is divided into basically two parts. SOPL, statement of profit or loss. SOFP, statement of financial position. Statement of profit or loss takes into consideration the revenue, what they generate in the business. From revenue, they're going to deduct all the expenses and add all the kind of incomes. The final result will be net profit. So statement of profit or loss gives you the idea about company's performance, how it's been, and you will know the performance of the company via net profit. Okay. Now, statement of financial position includes all the assets of the business, liabilities of the business, and equity. Then assets can have a division of current, non-current assets. Non-current again division of tangible, intangible assets. Tangible assets are physical substance. That means you can touch them. They exist physically. Intangible do not have physical substance. That means they are usually in documented form. Equity liability again can be divided into two: current, non-current. If I tell about current assets are those which give economic benefits within 1 year time. That means less than 1 year time it takes for you to give the economic benefits. Non-current assets give economic benefits in longer time, that is beyond a year or more than 1 year. Current liabilities are obligations. You need to pay them in the future. Current liability, obligations to be settled within a year. Non-current obligations can be settled beyond 1 year. Equity is the capital introduced by the capital introduced into the business. It is the shareholders' money which is introduced into the business, and then company also earns profit every year, which they transfer into an account called retained earnings account. That profit which is transferred to retained earnings is also a source of future capital that can be reinvested into the business. So this is what is this financial statement all about. But one more account, some few more new accounts you're going to see. With SOPL, you'll see OCI, other comprehensive income section. With statement of financial position, then you will see statement of changes in equity. This we will be studying. I'll give you a rough idea about it, not something to worry about. See, in SOFP, so I will just make formats for you and show you. Our formats are already given in the book. We will discuss those formats. So SOC is to be discussed a bit later. We will do that discussion. First, let's enter into the first page. So this is a rough idea I've given to you. But yeah, what is OCI? See, when there is SOPL already existing, statement of profit or loss, which has all the income and expenses in it, why there is a need for one more account called OCI? We see whatever the realizable nature income we earn, like profit on sale of any asset, we show in SOPL. Here the intention was to sell and we got a profit. That profit, the transaction was a cash transaction, and the profit also got realized because money has been received. But if the intention is to hold the asset for longer period of time and you want to show the asset at its exact value in the market, that's called revaluation. The process of getting the actual value of the asset from the market, because it looks more realistic to show the asset at its market value. And the standards, what are the standards you're going to study in this? International accounting standards, international financial reporting standards. These standards allow you to do that. See, all the accounting treatment you're going to do as per the standards, because standards guide you how to give accounting treatments to any transaction which happens. So you have to follow the standards to give accounting treatments. So in the same way, like revaluation is a process whereby you revalue the asset. You want to show the asset at its most or at its current value, which is in the market. So here the intention is to hold, not to sell. You want to hold the asset. You don't want to sell the asset. So if you don't want to sell the asset and you want to hold the asset, any increase in the value of the asset, of course, is a gain, but not a realizable nature gain. You're not selling the asset, you are holding the asset. And if the asset value increases, shareholders definitely want to know whatever the assets are there in the company belongs to shareholders. They want to know how much is the increase and they want it to be accounted. If company uses the revaluation practice, that means they are revaluing the assets. Okay. Now, let's say there is an asset of $100,000. This year, they revalued it has become $120,000. So $20,000, we've got the gain. But you're not going to, you're not going to get this gain in your hands. It's a non-realizable nature income. So these kind of gains come under OCI section as revaluation gain. This can't go in SOPL because this is a non-realizable nature income, whereby the money hasn't come into your hands, but the value has increased, and those are book adjustments which we are doing. I would like you to just have a look through this all once. So have a look to this. I'm just scrolling down. Fine. So now we will look into some points. What does the standard say? So International Accounting Standard 1, presentation of financial statements. This standard exclusively deals with how to present a financial statement. Now, IAS 1 presentation of financial statement applies to preparation and presentation of general purpose financial statements in accordance with the accounting standards, which is IFRS. So, IAS 1, this is the standard number 1. What does it tell? It tells how are you going to present the financial statements. You are going to prepare it and you are going to present. What is the general purpose of preparing the financial statements? Of course, to know the actual position and the profits of the business. Position can be known through position statement, that is statement of financial position or balance sheet, and profits can be known through SOPL. Okay. And you're going to follow all the accounting standards thoroughly to prepare that financial statement or report. Now, we have already discussed about what statements we are going to prepare. Already SOFP, SOPL and OCI. SOFP, SOCE, SOCF, statement of cash flows. It's not only the complete set of financial statements you're going to prepare, you're also going to make some, have a column called footnotes or notes. It comprises a summary of material accounting policies and other explanatory information. See, there are some information which you can't give on the face of the statement. Let's say I'm making a statement of financial position. Accumulated depreciation method, I'm using a straight line method. That means for depreciation purpose, I'm using straight line method. So I can only adjust the asset value. Let's say 10% is the depreciation from the asset and write it. Okay, but which method I'm using, I can't write on the face of the statement. So this extra information I have to give in the notes, footnotes, which is prepared after the statements are prepared or after all the statements are done with, then additional information will be given in notes. Now, then what you have to do? You have to do a comparative analysis. This is a part of all the statements. You see any company, any listed company's statement you can take out from Google. It's publicly available from their official website or Google. You take Nike, you take any brand, like GlaxoSmithKline, any brand. So I don't want to take the names, but any brand, their statements are available. You will see a set of all this. Apart from that, there will be comparative information in respect to the preceding period. how the preceding period was and now how the things are. A statement of financial position at the beginning of earliest comparative period. This also should be there. Where an entity applies an accounting policy retrospectively. Don't worry, I'll tell you what is this. Or makes a retrospective restatement of items in its financial statements, or when it reclassifies items in its financial statements. Suppose what happens? Company is looking to change its accounting policy, which it needs to mention in the footnotes. As if company changes the policy, they have to give retrospective treatment as if they are using the policy from the beginning. They are making a change today, but they have to show that the change is not today, but it is happening from the beginning. That's called retrospective treatment. So don't worry, we will discuss this retrospective treatment. Of course, just a second. Now, IAS 1 also permits the use of other items than those used in standard, such as balance sheet. So what does IAS 1 say? IAS 1 is a old standard. So today we are going to use this term, but they also tell permits. They are not against it. They permit the use of other items than those in the standard. They permit balance sheet for statement of financial position, statement of comprehensive income for statement of P&L and other comprehensive income. You can use this for this, and you can use this for this. For SOPL, you can use income statement. Let's understand the statement of financial position and its format. There is a statement in front of you, generic company statement of financial position at 31st December 2007. The assets are non-current assets, prop PP, right of use assets. This is for leased property. Why is leased property called right of use asset? Because leased properties are not the owned properties of the lessee. Those are owned by the lessor. Lessor is a party which gives the property or finances the property to lessee to use the property, or pay the rents of the property, lease rental of the property, and use it. So they don't own this, but they have right of usage of that asset. That's the reason why it is ROU, right of use asset. Then we have intangible assets which do not have physical substance, already discussed. We are under the section non-current assets. Property, plant, and equipment is a tangible asset. Patents, trademarks, copyrights, franchisee, all these are intangible assets. Then you have all the equity instruments in the investments you have done. So long-term investments come under non-current assets. Current assets, which give you, so here all this give you economic benefits more than a year. Their amounts, see, this is the current year amounts, previous year amounts for comparisons. It is very important because if you are giving retrospective application, then also it's important. Just a second. Now, under total assets, the entire current and non-current assets total give you the total of assets. When you add current assets and all the non-current assets all together, when you add them, you get total of assets. Then comes equity and liabilities. Equity is the capital which we raise to start our business by issuing shares to the people. Those are called shareholders. Then retained earnings, the money which company has earned, whatever the profits company earns, It transfers into the account called retained earnings, and then that can also be a potential capital. So let's say 1 lakh is the retained earnings balance at the end of previous year, which becomes this year opening balance, and this year net profit is 30,000. So total balance in the retained earnings will be 1,30,000 this year at the end of this year. Opening balance plus current year profit and any other changes. Let's say dividends are paid. Dividends paid are to be subtracted or deducted from retained earnings account. We will, don't worry, everything we'll do in details. Revaluation surplus. You know what is revaluation surplus? As the property value is increasing, we have to account that increase in the value of the property if we intend to hold. So what we discussed, revaluation surplus or gain, we will show in an account called other comprehensive incomes section. Then here also we will show, and then we'll transfer to one more section called equity. So now you should understand what comes under equity. Equity has share capital, retained earnings, revaluation surplus, share premium. All these are a part of equity. So you will be revaluation surplus, you will be showing in OCI in the income statement. See, any transaction, whatever you do, two accounts are going to get impacted. One is income statement, and is another one is balance sheet, or one is statement of profit or loss, another one is balance sheet. So there also you have to show, here also you have to show. So in OCI you have shown revaluation gain, let's say 10,000. So here also you have to write revaluation gain or surplus, just amount. Okay, just amount, because this is a surplus account only. It's 10,000. That's the way. Okay. Other components of equity. So we have seen all other components of equity, premium, etc. Then it becomes total equity, or total of all the, you know, amounts which are shown in the equity section or capital. Then we have non-current liabilities, which has long-term borrowings, deferred taxes, any long-term provision created. We have total of long-term liabilities or non-current liabilities and current liabilities, which you have to settle in 1 year time. Trade and other payable, short-term borrowings, any long-term borrowing which is, let's say, of 10 lakhs. Of that, a current portion, 1 lakh, you have to settle in 1 year or within 1 year. Then current portion of long-term borrowings is also a current liability. Any current taxes payable, short-term provisions, total of current liability will get. Then after that, when you total all, you get total of liabilities, and then grand total, total of equity and liabilities. Total of equity and liabilities is this amount, total amount. This ends the balance sheet. Have a look through this once, please. Okay. So then comes current and non-current distinction. What is current asset? We have just 1 minute time, which gives economic benefits within 1 year. Economic benefits in a longer period of time, more than 1 year. So current assets, an asset should be classified as current when it is expected to be realized in or is held for sale or consumption in normal course of entities operating cycle. Operating cycle is generally 12 months period. It is held primarily for trading purpose, yes, like inventory, etc. For short term and expected to be realized within 12 months of the end of reporting period. Is cash or cash equivalent asset which is not restricted in its use. All other assets should be classified as non-current. If the asset is not a current asset, then it is a non-current asset. So basically, I've given you all the detailing about this. We have just 1 minute. Non-current assets, tangible, intangible, operating, financial assets of long-term nature, and they are the term operating cycle has been used several times above. So other terms with the same meaning can be used: fixed, long-term, etc. Operating cycle, time between when you purchase the asset for processing and their realization in cash or cash equivalents. So if the operating cycle is within 1 year, current assets. More than 1 year, then it is non-current assets.